Hello there from Shanghai. Today I want to talk a little bit about financial statements in China and how to interpret them. If you don't want to know how on earth the auditors of Evergrande were able to overlook $70 billion in overstated sales, well, maybe a video on TikTok might be more appealing. I've heard you can now watch someone gluing her face to Mount Rushmore. Otherwise, if you're interested in that topic, you will like this video. I have looked at companies in China for over 20 years. And previously I was partnered with one of so-called Big Four accounting brands. And now when I look at financial statements, in almost every case, there are big issues with regards to the accuracy of the financial performance reported. In this video, I want to explain a little bit why this is, why you have to be skeptical, and why there is no reason to be offended. I expect some criticism for people who are biased, but it doesn't help. The reality is that there are structural reasons why financial reporting for things happening in China are exposed to a high risk of inaccuracy. Financial statements that are not accurate lead investors into investments that cause them damage. The cases of 𝗧𝗂𝗋𝗄𝗃 or Evergrande show that there is a huge risk of financial damage losses if these financial statements are not understood. And in this video, I explain you a little bit the root causes, what is the reason for that, and what is not the reason for these problems. Let's explain a little bit a few technical terms because I think they're very important to understand. Some people say the accounting standards in China might be the issue, and I can tell you they are not. The accounting standards have evolved over the last 20 to 30 years in China, and what the regulators here tried to do, they looked into what's going on in the United States, what's happening in Europe, and they looked at the key standards, the United States GAAP and IFRS. And what they've done, they developed what they call ASBE, Accounting Standards for Business Enterprises. I don't go into the details, but what I want to say is they use the same mechanism like in the US, like in Europe, where they have specialized professional bodies like the Chinese Institute of Certified Public Accountants, and they have the Ministry of Finance, and there are some other regulatory bodies that get involved. They discuss new developments, new needs. They look at what's going on in the international arena, and they try to make it as comparable as possible. The overall result is that Chinese accounting standards, the ASBEs, are rather solid, and they're very comparable to International Financial Reporting Standards or US GAAP. Yes, there are differences, but whenever I look at financial statements for my foreign clients who have to translate them into the American accounting standards for their group reporting, there is a difference, but it is not material. If you want to learn more about Chinese accounting standards, ASBE, there's a great book. It's called China Master GAAP Guide. It's published by CCH. It's a publishing house I think it's called 𝗂𝗂𝘂𝗀𝗋𝗂𝗂, and you can get this book online. It's now available in the 12th edition. It's a great book for those who don't speak Chinese, who cannot read Chinese, but want to have a very comprehensive understanding what the content of Chinese accounting standards are, and that they are very solid, and they are not the reason why financial standards or why financial reporting in China sometimes have accuracy problems. So the root cause must be somewhere else, and I will talk about this in a moment. Now let's talk about management, the true root cause why financial statements in China are very often misstated. Before I do that, I want to explain a little bit in broad and simple terms 3 waves of Chinese business environment. I would say run about, give it, take it a few years plus minus, between around 2000 and 2011, 2012. China was a place where everybody was happy, where everybody was successful, where everybody was making money. And why? Because the decades of closure had created a huge demand after China's opening policy. So for everyone, it was possible to make sales, to make a profit. I always say my father's terrier could have been a general manager of China. I think he would have been equally successful, but probably being more likable than many of the GMs that were actually here. And that is not a joke. It was simply easy for everyone. Things changed around, I would say, 2012 to 2013. When this happened, the market became more mature and it was more challenging to sell the products at an acceptable price and to get acceptable payment terms. And this is also the time, 2013, 14 roundabout, when foreign companies made a decision to localize their management teams. And it had quite a few advantages. These people knew their way around, they spoke the language, they knew the regulation, and they could use their network. Then the last wave started, I would say, this is a bit judgmental, but say 2017, 2018, things became far more challenging than before. Now China became a very mature market, products were very well developed, there were many local competitors, and now it was very difficult to sell products at a reasonable price because there was more supply and the competitors were more sophisticated than they were before. Still, headquarters in Germany, in France, in Italy, in the US and everywhere, they had the high expectations from the glory days and they were not willing to settle for less than perfect. They increased the pressure or kept the pressure on their local management teams to deliver the same performance figures. And this is when the trouble started. A word about Chinese leadership culture in companies. And I know this will most likely offend or annoy some of you watching this video, but I can't help it. Based on my 20 years here, plus my year as a student, there is a certain habit in China for business leaders. And it's not about judging that as being right or wrong. It just has to do with the fact how these people were brought up in a very tough and a competitive system. So the fundamental leadership principle for many of these business executives is that they want to have ultimate power in the businesses where they are the GM or the CEO. They do not like the concept of checks and balances. And they do not like the concept of interference by headquarters from overseas. They want the ultimate power. This is how they were brought up. And success is everything for them. This recipe or this mixture of socialization and desire to control every part of the process of a company does create a certain leadership style that is sometimes not favorable if you want to have accurate financial statements. Because these leaders want to show success and they get paid based on good figures. So they do not want anybody in the organization to interfere, and they don't want internal controls to limit their actions. And of course, if they report bad figures, even if the market does not prevent it from happening, they see it as a lose of face, or they see it as a lose of performance, or something that is negative to them. And that is very important to understand when I talk about some other features like local management, certain business culture, and what does that mean for the culture of reporting financial statements. Now, there are two behaviors that are important to be differentiated. One is incompetence and one is willful behavior, meaning a behavior where fraudulent behavior plays a role. Let's talk about incompetence. Incompetence does not mean that the people are not capable. Incompetence means they are qualified, but they are unable either to lead the team in the right direction or to deliver the profit figures headquarter wants. Maybe they lack the business acumen, maybe they just lack the feeling for the market, whatever it is. Leaders in roles in China that lack incompetence see the financial performance declining, and they often interfere so that these financial statements look better than they really should. So this is incompetence, fearing that the lack of expertise or lack of performance becomes transparent. There's another behavior that's even worse, and that is willful conduct, where an executive deliberately does certain things knowing that it shows the performance in a way it shouldn't be done. And so these two behavioral patterns impact leaders who tried to impact the financial statements, tried to interfere in the financial reporting in a way that makes them look better than they really are. One of the issues with financial statements in China is the KPIs set by headquarters in the US, in Canada, in Europe, in Australia, Japan, have you not, are unrealistic. As I explained earlier, the market has changed. Still, these headquarters leaders don't accept that and have unreasonable expectations. Not only that, they are very often sales-centric. They want the top-line growth. In their own markets, they are dealing with mature markets, with aging demographics. So China is very often one of the few markets where they can report growing sales. And in order to continue the equity story of their own company, they emphasize that China has to deliver, that China operations have to deliver increasing top-line figures. And when they do that, they often neglect profitability and cash flows. So the behavioral the socio-cultural patterns combined with unrealistic KPIs and KPIs that are not really meaningful to guide a company into profitable growth create an environment where the local management teams do not produce the financial figures they should. They interfere. And I just explained that the Chinese accounting standards are very comparable, absolutely comparable to Western standards. But they deviate from these standards. So the problem is that when they should write off an asset, they don't do it. When there is inventory that is too high because it's worthless, they keep it. When payment terms with customers are too long and cash flow suffering, they try to cover that up through by booking it into certain accounts or by somehow trying to make things intransparent so that it will take several years for headquarters to uncover the trend that management is growing the business at the expense of profits and at the expense of cash flows. So wrong KPIs, wrong mindset and culture causes management to influence their finance departments, to make journal entries that they shouldn't do, and prevent them from writing off assets when they should do. A word about foreign GMs or foreign CEOs of China businesses. The issue that they try to interfere in the financial reporting to make numbers look better than they really are also exists when the CEO or GM is a foreign national. Very often, for whatever reason, they like it in China, have a Chinese wife, like the environment, don't want to go back. And for them, the labor market is a niche market. So they do everything they can to look as good as they can and sometimes to look better than they really are. So it's a similar issue than with local GMs. I'm just saying this is not exclusive to a certain nationality or ethnicity. Let's talk about the role of the auditors. In all the major cases in China, in the US, in Germany, wherever, there have been accounting frauds where the fraud was detected after years of financial reports, financial statements audited and issued with an unqualified audit opinion by reputable audit firms. The trust of the public in audit firms is completely beyond any imagination, and it's overblown. As someone who has worked for over 20 years in one of these organizations, I can tell you, you need to understand what the role of an auditor is and the specific situation for statutory auditors in China. Very often people use the term Big Four and they use the term Big Four firm. There are no Big Four firms. There are international networks that use a common brand, and the largest four of these organizations are called Big Four. They are KPMG, or it's the brand KPMG, Ernst & Young, Deloitte and PwC. There is no global firm with any of these names. And these organizations are very transparent. If you look at their websites, you will see that they are networks of independent firms. So, if you hear that PwC in China was now banned from auditing for 6 months, or that they had to pay a fine, this is related to a Chinese legal entity that is part of the PwC franchise. It is a franchise. But important is to understand whatever gets audited in China is audited by a Chinese firm, by a Chinese legal entity, and not by a group of international auditors. This is very important. And I personally find it questionable that the Big Four or Big Six or Big Eight, is depending on how you want to define and create the boundaries of large organizations that offer audit services, that they create the illusion that there is some form of international involvement. It's not. As a matter of fact, China is very particular about data transfer and state secret, and they definitely do not want anybody from the US flying in, auditing a state-owned enterprise and getting access to sensitive information. This is not specific to China. Every country does that. It's the same in the United States, it's the same in Italy, in Germany, and so forth and so on. But for you, it's very important to understand, be it Evergrande, be it Luckin Coffee, they were audited by Chinese audit firms that were part of an international brand. This is number one. Another thing is, what is the role of a statutory auditor of financial statements? And here China is very similar to what you can find in Europe, in the US, and other markets. Auditors go through financial statements that were prepared by management. And the only thing they do is to say that based on the information that was given to these auditors, that the numbers that are presented are in accordance with the Chinese accounting standards. They do not more, no less, sometimes they do less. But what is important is to understand these guys are comparable to someone like your annual tax inspection of your car. If you pass, doesn't mean your car is worth a lot or great. It just means you're allowed to use your car in public traffic. And it is the same with audited financial statements. And the fact that companies like Evergrande or Luckin Coffee have overstated their revenues to a massive extent, and this was not uncovered by the auditors, shows that the process doesn't provide much assurance. And I want to explain why. You need to understand the business culture. In China and elsewhere, the company that gets audited is the customer. They pay. And particularly in the Chinese business context, a customer has the say. And the customer is not to be questioned, challenged, or disputed. Now, you have to challenge your customer. This is totally, I would say, counterintuitive to the Chinese business culture. Checking your customer and challenging your customer is not part of the deal. Also, a fraud investigation is not part of a statutory audit. There is a set of audit procedures determined by the regulators. They're called standards on auditing. There's an international framework called ISA, International Standards on Auditing, and China has standards on auditing. Again, like its accounting standards, they are very comparable to what you find internationally. The problem is the application. The problem is the limited mandate, and the other problem is the practice. And I know what I'm talking about. When I started as an associate in an accounting firm in Germany, we had to work many hours. We just came out of university. We were sent to the client with many questions. We were trained, but most of the time spent on audit is time spent by rather junior staff. Audit firms make their money by sending young people to the customers. And yes, the working papers are reviewed, but it is not the same like sending highly experienced people to the field. And they don't do that for cost reasons. The other issue is revenue per partner is the most important figure according to which partners in these accounting firms are measured. And this revenue pressure always puts them into a constant conflict. Should I reject this client? Should I challenge this client, who then might choose not to work with me anymore? And that has for that individual partner enormous consequences. In other words, the whole structure of challenging your client is not favorable to the audit partners. Hiring very expensive and seasoned staff is not enabling them to make the profits they want. And one other thing is, audit firms don't earn much for an audit. That might surprise you, but you can look in the public financial statements of companies and you will see very often how much is paid in audit fees, and you will see it's a tiny amount given the size of the company. That means audit firms are not paid well, and because of that, they are forced to look at the cost and have largely junior staff to do the work. Yes, the work gets reviewed, but that is not sufficient. Once a primary data point has not been really uncovered, for example, overstated revenues, it's very difficult for the audit partner or senior manager who will use the working paper to find the issue. So the mandate, the whole setup, the commercial structure does not really make the auditors a reliable counterpart that helps to uncover misstatements in financial statements, be it in China, be it elsewhere. But I think in China it's pronounced because of the business context, the business culture, and because also of the enormous revenue pressure that exists for partners in these firms. If auditors or what they do doesn't help preventing misstatements of financial statements, so what can be done? Most important is the governance. If you have a business in China, if you have a subsidiary operations, headquarters is responsible for implementing a governance structure that works. And that means you need to understand the pressure the local management is under, and you need to make sure that checks and balances are practiced and not just talked about. You need to understand that the local GM wants to be the emperor in his little empire and doesn't want to be disturbed. And you need to implement the governance, the controls that prevent him from doing that, or her. There's also an expectation gap. You need to adjust to the realities of the Chinese market and don't come up with expectations that lead your team in the wrong direction. If you focus on sales, they will do exactly that. So it's important to get the right KPIs in place. And these right KPIs are net income and not some adjusted EBIT or EBITDA figures. They don't make any sense for China or in other countries either. So it's very important to have the right KPIs that incentivize the team to do the right thing. But you also need to accept the fact that margins are declining. It's a mature market, and it makes no sense to put local teams under pressure that they cannot withstand, or where they have an incentive to avoid telling you the truth through misstatements of financial reporting. There's something else, and that is important for foreign investors. Don't rely on indulgence letters. Indulgence letters are audit reports or big name in the audit industry, or any financial advisors or your banker who recommends you to invest in a Chinese asset that you don't understand. If you just rely on other people that everything will be okay, you will end up like the probably hundreds of thousands of investors who are now waiting for their money, and they will probably never get it back. And I read in a congressional report that around 300 billion US dollars of debts are still outstanding with regards to Evergrande. They will never be paid back. And believe me, auditors, bankers, financial advisors will not accept any responsibility. If you look at what they make you sign, you will always see they never accept any responsibility. So don't believe any indulgence letters issued by people who say, we are a famous firm. It doesn't matter. You bear the responsibility. So it is important to understand, is there proper governance, and if there is not a proper governance, or if you cannot judge it. For example, Evergrande was a Chinese company. How should you know this? Or Luckin Coffee. There is no way you can trust that there are sufficient checks and balances to avoid a behavior you don't want. Let me just summarize what you can do, what a company can do to mitigate the risk of misstatements of operations in China. Do not simply trust your leadership team. I had a great boss. He was the CEO of a global organization, and I remember he was interviewed by a newspaper, and he was asked, do you trust your clients? And his response was great. He said, in God I trust, my clients I audit. And that is a very good phrase, whether you're religious or not. In business, you need to have a certain base level of trust with each other, but when there are transactions, understand that people you work with who are employees of your company, they have their own interest. So don't simply trust. Just because someone speaks Chinese doesn't mean he understands the Chinese market, and it also doesn't mean he is your friend. So have facts ready, and that is only possible with a strong internal control, and don't rely on auditors. I just explained, auditors have failed many times in the recent decades, and they will continue to do so because they don't have the right mandate, they don't get paid properly, and they operate in an inherent conflict of interest. That is the reason why tax authorities in every country do their own checks and their own audits, and they don't rely on statutory auditors. Statutory auditors are big job machines and big training centers for young people who just come out of university, and they do a great job at that. But they don't provide sufficient assurance. So don't rely on audit opinions. Understand the local culture. Things are what they are. And in China, you have very ambitious and well-trained people who do a great job. But they also have their own agenda. They also have the incentives to be successful at all costs. Second best is not an option for many people in China. And you need to understand that you're dealing with that culture when you put a team in responsibility in your China operations. And when you invest in a Chinese company, you need to understand that the success for these individuals is everything and not the success of the company. It's very important to understand the cultural context, that this is not a culture of confrontation to resolve an issue like in the United States. Things are done differently here. You just don't go to a lawyer, and you just don't go to court to get things your way. It's not how it works. Have a majority of board seats represented by people trusted by headquarters or sent by headquarters. Those people don't have to be here permanently, but if you want to make changes, you can do that immediately. Once you leave this in the hand of your local management team, and I see this all the time, it is very difficult to change course. Yes, you can do that, you can have a shareholders meetings, but it makes things very complicated and very expensive. Very important, visit China. Go to China, bond with your team, but don't waste time for dinners and drinking this baijiu liquor or schnapps, as we say in Germany. It is an awful drink from my perspective. And it doesn't matter. You need to spend time with the people, and you need to spend time with the numbers and with the operations of the company. Visit China from time to time. It's the only way you can bond with the people. The only way you can create trust and get your own primary data revealed yourself. Maybe you need an expert, an external expert. That is not a problem. These people exist. But it is important that you take ownership of your China operations and look at the financial statements yourself. Because if you don't do it, nobody else will do that for you. The management won't and the auditors won't. Employment terms, last thing. Set the right KPIs. Make sure you have employment terms for your leaders in China, that they are accountable for a real result, net income and cash flows. And have covenants that allow you to early terminate employment agreements if they don't perform. And also have terms in the employment agreement that forces them, that requires them to work with you if you want to investigate a certain issue related to the financial performance. For that, for the last 2 points, you do need a specialized lawyer, because they know what's allowed and what's not allowed. I hope I have, in a very compressed way, explained why you cannot simply trust financial statements that you receive from anything happening in China, be it that you're an investor, be it that you are the owner of a business here. I hope I could have explained what you could do about it. Please spend time in China. It's a great place, funny place. Don't waste time. Don't drink too much alcohol. Spend time with some people. Come over here. If you have questions, something specific, you can send me an email. You can find the email below and in this video. And more than happy to tell you more. I hope you enjoyed this video. I hope you enjoyed beautiful Shanghai here on 𝗂𝗂𝗰𝗸𝗂𝗃, right? I hope you enjoyed 𝗂𝗂𝗃𝗃, the background, the people here all curious, watching us. I always enjoy this video. Thank you.